Hello, everyone. So this is the fifth slide video of the chapter 13. And as we know, so far, the accounting treatment for investments is a little bit complicated. So if you have some questions, send me email. I'm here to help you. So do not hesitate and do not accumulate some confusions. So, okay, so this video will have a detailed discussion about transfer and impairments of investment. As we know, for investments, different motivations to invest the money or hold the investments will lead to different accounting treatment. And the difference will focus on the unrealized gains and losses reporting. We will have some, for some securities like trading securities, the unrealized gains and losses will go into the income statement for late income. But for some others, for example, for the available for sales security, the unrealized gains or losses will go into the comprehensive income in the balance sheet. And some others may be only disclosed in the footnotes of the financial statements. So if the holding motivation changes, we need to change the accounting treatment for this kind of security. And research shows the information in the income statement will be very different from the balance sheet or not disclosure in the financial report. So, so there is some space actually that has ethical issues. In the textbook, there is a one paragraph to demonstrate the ethical issues. For example, on the balance sheet date, some companies sold all of their the securities that have a higher fair price, and keep all of the securities that the fair price is lower than the book value. And by this way, they can increase the earnings for that period. But then, you know, there's some discretions, but it's about ethical issues. So please read the textbook and know that. So here, we would like to use examples to show this kind of change. So, and focus on the category change will focus on unrealized gains and losses. So a transform from trading category into other categories, because for trading category, unrealized holding gains is to go into net income in the income statement. So after the transfers, the net income cannot record the unrealized gains or losses. It depends on what kind of category the trading security will become. We will have an example in the following slides. And a transfer from trading category from other categories, that means after the transference, the unrealized holding gains or losses can immediately come into late income and in the income statement. Same reason if a transfer into available for sale category from held maturity category, because held to maturity category only disclose the unrealized holding gains or losses in the footnote. So after that, it can be disclosed in the balance sheet as one part of comprehensive income. And the same reason, a transfer of debt security into held to maturity category, that means the unrealized gains or losses will only reported as a footnote. So we will have examples to show that. For example, Hay company purchased the bonds and classified as available for sale. You know, at this time, actually, they used some professional judgment. The management say, okay, this investments should be categorized as available for sale. And then we will use fair value to journalize this investments. So the face value is $5,000, and then on December 31st, the fair value is $6,100. So here we have a unrealized $1,100 unrealized holding gains, and this will reported in other comprehensive income in the balance sheet. And in 2020, the fair value increased from 6,100 to 6,300. And at this time, the management will say, okay, we will reclassify as a trading category. And you know, trading category can directly record the unrealized holding gains or losses in the net income, in the income statement. It will have a positive influence for their potential investors or investors. So for this change, we made two journalization. First, debit investment in trading security. It's because on the transference date, the book value, I mean the balance of the security in the financial statement is 6,300, and it includes the face value $3,000. So debit investment in trading securities, credit investment in available for sale security, because this security is already become a trading security. And at the same time, the gain on transfer of security already become trading security, the principle. Because at this time, at this date, on this date, the book value, the balance is 6,300. And then after that, we need to transfer the $1,100 unrealized holding gains from the comprehensive income into net income, directly go into income statement. So debit unrealized holding gains available for sale securities. This is this unrealized holding gains is for available for sale security. Now we will finish this one and transfer into the late income is created allowance for change in fair value of investment. This is for trading security. So debit unrealized holding gains available for sale security, created allowance for change in fair value investment. Another example is, so the explanation for the example is in the first journal entry, the investment is transferred to the trading security as its fair value. And also, this is the current balance in the financial statement. And at the same time, amortize the cost of securities, removed from available for sale into trading security. And at the same time, the gain $1,300 transferred into the late income for 2020. And the second journal entry just eliminated the unrealized holding gains of $1,100 into related allowance account. That means it will be in the, it's a control asset account. Okay, and then it also explained that this reclassification is included in other comprehensive income for the period. And the late effect of this transfer increased comprehensive income by $200. And the later amount of gain in comprehensive income reflects a change in the fair value of these securities during the period and adjusted by amortization of the premium or discount. Okay, in this case it's 0. Okay, so anyway, for this kind of transfer, remember 2 steps. The first step is record the current balance of the security and record this number, this amount into the new category as a initial cost of the new category. And after that, deal with the unrealized holding gains and the losses. Assume the category is already changing. And step by step for the cost, the initial cost, or the transfer cost, and also unrealized holding gains and losses. As we just introduced, the unrealized holding gains and losses is a bigger change with the change of the category of securities. Okay, another example is a transfer into available for sale from held to maturity. You know, held to maturity is unnecessary to disclose the unrealized holding gains or losses, or only disclosed in the footnotes of the financial report. But available for sales security, we will disclose the unrealized holding gains or losses in the comprehensive income in the balance sheet. Okay, so the example is Denford company has bonds classified as held to maturity, and the face value is $10,000, and the fair value is $9,500, and then Denford transfer the bond into available for sale. So at this time, we recognize the investment to investment, the new category, investment in available for sale security, debit $10,000, credit investment held to maturity security $10,000. Based on this generalization, we eliminate invest in held to maturity security and add investment in available for sale security. But the fair value is only 9,500. So we need to recognize this unrealized holding gains or losses because it's available for sale security. So we use allowance for change in fair value investment and go into the comprehensive income in the balance sheet. Okay, but if the security has a premium or discount, we also need to deal with the premium or security. But in this case, we don't have. So, and then assume this company bonds currently classified as available for sale and is transformed into held for maturity category. If the fair value is 9,700 and current fair value, the balance of in the financial report is 9,700 and the current fair value is 9,500. Then we record this as a fair value, investment in held to maturity security, 9,500. And at the same time, we eliminate investment in available for sale security is $10,000. And in this case, we have 500 unrealized loss. So we record this debit unrealized holding gains is a loss. Holding loss held to maturity security. And at the same time, there is a difference between the fair value change. 300, it's 10,000 minus $9,700. So debit allowance for change in fair value investment created unrealized holding gains or losses. Here is a loss because the fair value is less than the face value, the book value, the initial cost. So we need to also accounting for the unrealized gains or losses for the previous the previous accounting period. Okay, and also from 2016, Financial Accounting Standards Board require accounting for the impairment of impairment for the date. So we have two methods to record this kind of impairment. So this impairment recording or journalization is about an active look of economy. It requires accounting timely reflect the record of credit losses or other for loans or bonds and or other financial instruments. It's about economic, negative look of economic. For example, the COVID-19 pandemic has a very negative impact on the economy, and then the accounting, the bond value will reflect this kind of thing. And from 2016, FASB first of all require this kind of impairment. It's like intangible assets impairment. If the outlook of the economy has evidence shows the value already decreased. Okay, and so two methods. One is for held to maturity security. We use current expected credit loss, is called CECL. Another is for available for sale. It's AFSCL. So the accounting treatment is the same. Under the CECL model, a company would evaluate the financial assets with similar characteristics on a collective basis when similar risk characteristics exist. For example, the COVID-19 is a risk signal, and then we need to review the value to see the fair value, whether the fair value is lower than the current balance value in the financial report. So at each reporting date, the company will report is held to maturity investment rate as allowance for credit loss. Okay, see example. On July 1st, 2019, Duke purchased at a par value $500,000 in debt security, and is held to maturity security. And on December 31st, the fair value become $450,000. So an evaluation $50,000 decline in fair value is attributed to two factors. One is unrealized loss due to temporary increase in interest rate. And another is due to expected credit loss. Okay, so expected credit loss is different from temporary interest rate change. It's about the expected credit loss is about the outlook, the look of economy, the negative look of economy. That means the future will have signal say there is some risks for the economy. So the bond will decrease its fair value. So in this case, we recorded the impairment $3,000. So debit credit loss expense, credit allowance for credit losses. So this loss is directly going to late income in the income statement. And also, oh, I'm sorry, this is 3,000. Yeah, it's a debit or credit loss expense, credit allowance for credit losses. And also the credit loss expense is reported in the income statement. And the allowance for credit losses reduces the investment to the amount of the Duke expects to collect. And after that, the fair value increased for example, the COVID-19 is stopping, and then the economy outlook it looks more promising, and then we can treat it back for the credit loss expense we already journalized. So in this case, is debitor allowance of credit losses, credit loss expense. Okay, so here because the fair value increase because so we after class actually before the class you need to read the slides and textbook. So because the video will speed up, we have no time to do that for this kind of online class. Okay, so that's for how to mature the security, the impairment. And same reason for the available for sale security for the impairment. Okay, and same accounting treatment for the fair value decrease because of credit loss. Okay, and then you need to read this kind of digest this kind of because this the accounting mechanism is totally same as the CECL, so it's unnecessary to explain again. Okay, so that's this video. See you next one.